Welcome to the Deep Dive. Today we're getting into IAS 36, Impairment of Assets.
Right. A really important one. We've looked through the standard, some analysis.
Yeah, and our mission really is to figure out how companies spot when an asset's value has dropped and, what they actually do about it.
It's like a financial health check for company stuff, isn't it? Their property, equipment, goodwill.
Exactly. And it wasn't always just one rule. IAS 36 pulled together requirements from other standards back around 2001.
And it's seen updates since then, 2004, 2008, mostly refining things, especially around business combinations and later disclosures.
Okay, so let's maybe pin down some key terms first to make sure we're all on the same page.
Good idea. First up,
Yeah.
carrying amount. That's simply what the asset's worth on the books.
Yeah.
After depreciation and any previous impairments.
Got it. Book value.
Then the big one, recoverable amount. This is crucial. It's the higher of two things. The asset's fair value, less costs of disposal.
So what you could sell it for minus the selling costs.
Exactly. Or its value in use, which is the present value of the future cash flows you expect to get from using the asset.
Right. So selling versus using, whichever gets you more back.
Precisely. And if that recoverable amount is less than the carrying amount, boom, that difference is your impairment loss. That's the aha moment, or maybe the oh moment.
It's probably more like it. Okay. And what about groups of assets, like a whole production line?
Ah, yes. That brings us to the cash generating unit, or CGU. It's the smallest identifiable group of assets that generates cash inflows, mostly independent of other assets. You often test impairment at this level.
Because some assets don't really work alone. Makes sense. And corporate assets, things like the head office building.
Yeah, those support multiple CGUs. Think HQ, maybe some central IT systems. They complicate the allocation of impairment a bit, but they still need to be considered.
Okay, clear enough. So how does a company even know when to start looking for impairment? What are the triggers?
Well, the standard lists indicators. Some are internal, things you notice inside the company.
Like what? Stuff breaking down?
Yeah, physical damage, or maybe an asset becoming obsolete faster than you thought, or just worse than expected performance. Higher running costs, lower profits from it.
Kind of like your car is suddenly needing expensive repairs and guzzling gas.
Exactly that kind of thing. Then there are external indicators too. Stuff happening outside the company.
Market changes.
A significant drop in the asset's market value. Maybe adverse changes in technology, the economy, the legal environment.
Or interest rates going up. That would affect discount rates for value and use, right?
Absolutely. Higher interest rates mean future cash flows are worth less today, potentially lowering the value in use. Another external flag is if the company's total market value, its market cap, drops below its net asset value on the books.
That's a big red flag, surely. Suggests the market thinks all the assets together are worth less than the accounts say.
It definitely prompts a closer look.
Yep.
So once you have these indicators, you need to measure that recoverable amount.
Right. The higher of fair value, less costs of disposal and value in use. How practical is calculating those?
Well, fair value less cost of disposal aims to reflect the market price in an orderly sale, minus direct costs like legal fees or removal costs. If there's an active market, it can be quite straightforward.
Okay, market price minus selling costs?
Value in use is more internal. It involves forecasting future cash inflows and outflows from the asset's continued use and eventual disposal. Then you discount those cash flows back to their present value.
Discounting. That involves picking a discount rate, doesn't it? Reflecting risk and the time value of money.
Yes, and that's critical. It needs to reflect the specific risks associated with the asset's future cash flows. Estimating those flows and picking the rate, that requires significant judgment.
I can imagine. Do they always have to calculate both? Fair value and value in use?
Not necessarily. If either one is already higher than the carrying amount, you don't need to calculate the other because there's no impairment.
Ah, okay. Save some work.
And sometimes fair value less cost of disposal might be difficult to determine reliably, maybe for very specialized assets with no active market. In that case, value in use might be the only option for recoverable amount.
So let's say they do the math, and the carrying amount is higher than the recoverable amount. An impairment loss exists. What then?
Then you recognize that loss immediately. Usually go straight to the profit or loss statement as an expense for the period.
Hitting the bottom line.
unless the asset was previously revalued upwards under a different standard, like IAS 16 for property, plant, and equipment. In that case, the impairment loss first reduces the revaluation surplus in other comprehensive income before hitting profit or loss.
Okay. And for a cash-generating unit, where does the loss get applied?
Good question. If a CGU is impaired, the loss is allocated. First, it reduces any goodwill allocated to that unit.
So goodwill takes the first hit.
Yes. If the loss is bigger than the goodwill, the remainder is allocated to the other assets in the unit, usually pro rata based on their carrying amounts.
But you can't write an asset down below zero, right? Or below its own recoverable amount if that's measurable.
Correct. There are limits. An asset's carrying amount shouldn't be reduced below the highest of its fair value, less cost of disposal, its value in use, if determinable, and zero.
Okay, makes sense. Now, what if things turn around? The market recovers, where the asset becomes useful again. Can you reverse the impairment loss?
Yes, you can, with one major exception. Reversals are allowed if and only if there's been a change in the estimates used to determine the recoverable amount since the last impairment loss was recognized.
So the reason for the impairment has actually gone away or lessened.
Exactly. Maybe market conditions improved, discount rates fell, or the asset's expected performance got better.
And how much can you reverse?
You reverse the loss, but the asset's carrying amount can't be increased above what it would have been, net of depreciation, if no impairment loss had ever been recognized in the first place. There's a ceiling.
So you can't magically make it worth more than it would have been anyway.
Right. And the reversal is usually recognized in profit or loss. Unless the asset is carried at a revalued amount, then it might go to other comprehensive income, mirroring how the loss was first treated.
And the exception you mentioned.
Goodwill. Impairment losses recognized for goodwill are never reversed. Once it's written down, it stays down.
That's a crucial point. No second chances for goodwill impairment.
Not at all.
So, to recap, IAS 36 gives us this framework. Identify potential problems using indicators, measure the recoverable amount looking at selling it or using it, recognize a loss if needed, allocate it carefully, especially for CGUs starting with goodwill, and potentially reverse that loss later if things genuinely improve, but never for goodwill.
You've got it. It's all about ensuring the balance sheet reflects economic reality as best as possible regarding asset values.
It really makes you think, doesn't it? Even on a personal level, you kind of informally assess if your big purchases are still worth what you thought, or if their value has changed significantly.
Absolutely. It's the same principle, just formalized and much more complex for large companies. It ensures investors get a clearer picture.
Definitely food for thought. So next time you see asset impairment mentioned in company news or reports, you'll have a much better grasp of what's going on behind the scenes. Thanks for joining this deep dive. Thanks for diving deep with Deepcast AI today. If you enjoyed this, give us a like and definitely subscribe and ring that notification bell so you're first in line for our next exploration.